5 high-paying dividend stocks you should own. If you were like me, you were always looking out for that happy mix of dividend and growth stock. Most of my income stream funnels into my stock portfolio, and I have a set and forget approach. And I tend to dollar cost average as I go. Today I'd like to look at 5 stocks you can include into your portfolio that I believe show promise on the growth side as well as an attractive dividend yield. Now, I'm no financial advisor, and I always advise you to do your own due diligence before investing into anything. However, all of today's picked trade on the S&P 500, so check this stuff out before handing over your hard-earned cash. And as always, be sure to stay to the end and let me know if you own any of these dividend producing stocks already. Williams Inc. Dividend yield 5.6%. The roughly $36 billion Williams is not a particularly iconic energy company, in part because it's a different flavour of stock with a focus on midstream operations. As long as end users are taking delivery of these energy sources, Williams can charge a decent fee along the way to power its $1.7 in annual dividend distributions. Devon Energy Corporation, dividend yield 6.2%. Another high-yield energy stock in the S&P 500 at present is the $35 billion rated Devon, an Oklahoma-based independent oil and gas exploration firm. Operating exclusively in the US, DVN owns and operates more than 5,100 wells nationwide. The company's dividends have surged from just 9 cents per share quarterly at the end of 2019 to a stunning $1.27 paid in its most recent quarterly distribution. When you add up the last year of payouts, you get a yield that is roughly 4 times that of the typical S&P component. Some see natural gas as important bridge fossil fuel because it burns cleaner than coal or crude oil, and right now is reasonably affordable when compared with the alternatives, with the exception of wind and solar. The company operates some 17,500 miles of natural gas gathering pipelines, 1,500 miles of interstate pipelines, and a few dozen storage terminals and processing facilities. The highly regulated nature of this business and the capital hurdles to competition means that it's not likely OKE will see any major distributions to its bottom line or its dividend anytime soon. Kinder Morgan Incorporated, dividend yield 6.5%. KMI is an energy infrastructure company that mainly operates pipelines, processing facilities and storage terminals for various energy commodities, including gasoline, diesel, chemicals, ethanol and various petroleum products. With crude oil prices above $100 a barrel, there's a tailwind in the sector that has helped lift many other energy stocks this year. But on top of the modest returns for Kinder Morgan, while the rest of Wall Street is deeply in the red, you get a generous quarterly dividend of almost 28 cents. Vornado Realty Trust, dividend yield 7.2%. Real estate operator Vornado barely makes it into the S&P 500 index with a valuation of just $6 billion or so at present. But while it's not one of the best known S&P 500 dividend stocks, it's worth a look because of its stable business and long-term income potential. VNO properties are concentrated in the nation's key metropolitan markets, including prime properties in New York City, Chicago, and San Francisco. And while the pandemic did spur growth in the work from home trend, VNO's attractive locations and best-in-class properties make it less at risk of disruption than other players in the years ahead. Hey, have you invested in any of the above companies before? Let me know your experiences in the comment section below, and I'll be sure to get back to you as soon as I can. Now there's one more company that I'd like to share with you, but it's not everybody's cup of tea. It does have a good dividend payout, so check this out. Altria Group Inc. Dividend yield 8.3%. Altria is the US arm of what used to be Philip Morris before its 2008 spin-out. It sells top cigarette brand Marlboro, as well as cigars under the Black and Mild nameplate, and smokeless tobacco products including Copenhagen and Skoal. Big tobacco doesn't exactly conjure up the idea of growth, given the obvious health risks of these products, but Altria has proven to be a slow and steady stock that pays consistent dividends from its well-run and resilient operation. Right now, the stock is paying $3.60 annual dividend, which remains comfortably under its projected $5.11 in earnings per share for fiscal 2023. This means the income potential of this stock is still sustainable and could perhaps support modest increases over the coming years. Hey guys, thanks very much for watching. I hope you got some real value from this video. Be sure to check out some of these other videos on the channel and hit subscribe if you're feeling up to it.